Welcome to Casa Academy Chapter 5, Part 7, where we will cover real estate brokerage activities and procedures. Today, we're focusing entirely on a topic that is absolutely the lifeblood of a broker's professional integrity and regulatory survival. I'm talking about escrow accounts. You know, when you hold other people's money, the stakes literally couldn't be higher. So we're going to break down the exact frameworks and legal boundaries you need to know to stay compliant.
Okay, let's dive into this. When a broker makes the choice to act as an escrow agent, they aren't just opening up a standard bank account. They're taking on a really profound set of responsibilities. You're stepping into a role that demands strict adherence to Florida regulations, and these rules exist for one primary reason: protecting the public. We absolutely must ensure that money belonging to others is properly safeguarded at all times. Now, one of the foundational rules you need to lock in right now is separation. Escrow funds for different purposes have to be kept completely separate. For example, if you have escrow deposits for real estate sales, and you also have escrow funds for property management, those cannot share the same space. No way. They must be maintained in completely separate escrow accounts. And it goes without saying, but a broker or property manager can never, ever mix these escrow funds with their own business operating funds or personal money.
Here is our danger zone and safe harbor roadmap for mastering this topic. Number 1, commingling and conversion violations. 2, permitted personal fund limits. 3, setting up escrow accounts. 4, monthly reconciliation requirements. And 5, mandatory record retention. Let's get to it.
Let's enter Section 1, Commingling and Conversion Violations. Welcome to the Danger Zone.
Mishandling other people's money is a massive liability problem. Honestly, it's the kind of issue that can end a career overnight, which is exactly why regulators take it so extremely seriously. The first major violation you need to understand is commingling. This is defined as the mixing of escrow money with personal or business money. Remember, escrow funds do not belong to the broker. They belong entirely to the parties involved in the transaction. Because that cash isn't yours, placing it into a personal account or dropping your own money into the escrow account without a specific legal exemption is a severe breach of trust and a major regulatory violation. You've got to maintain that rigid wall of separation. Now, if commingling is bad, conversion is even worse. Conversion happens when escrow funds are actually misused, commingled, or when a broker simply fails to properly account for money belonging to others. Make no mistake here, conversion is legally considered a form of fraud. Let's paint a picture of how this usually happens. Imagine a broker is having a really tough month. They decide to take money sitting in the escrow account to temporarily pay the office rent, keep the utilities on, or maybe make payroll. In their mind, they might intend to replace those funds the minute a big commission check clears next week. But under the law, that intent doesn't matter at all. The temporary use of that escrow money is conversion. Period. Another clear example is if a broker is legally required to produce money or property belonging to another party and is unable to do so. That failure to account for entrusted funds is also conversion. Regulators treat these as absolute top-tier offenses. All right, moving to Section 2, permitted personal fund limits. These are our safe harbors.
So, while the wall between personal funds and escrow funds is incredibly strict, Florida law recognizes the reality of modern banking. They allow a very small, highly specific exception just to keep accounts open or cover normal bank service charges. The crucial point here is knowing exactly what these permitted limits are because they actually differ based on the type of account. For a sales escrow account, a broker may keep up to $1,000 of personal or business funds. However, notice the difference for a property management escrow account. A property manager may keep up to $5,000 of personal or business funds. You absolutely need to memorize these exact numbers. If you put $1,001 of your own money into a sales escrow account to cover fees, you've crossed the line. Exceeding these specific, rigid limits drops you right back into the danger zone of commingling.
This brings us to a vital regulatory question regarding the physical location and structure of these funds. Where must these accounts be held? Now, your verification code is 357852. Let's look at the answer to how we properly establish these accounts to ensure total compliance.
Section 3, Setting up Escrow Accounts, the Structural Rules.
The state doesn't just care about how much money is in the account. They care deeply about where it sits and who has control over it. First and foremost, the escrow account must be maintained in a Florida bank, savings association, or credit union. Why? Because this guarantees that the state of Florida has absolute jurisdiction over the account. If there's an issue, Florida regulators can actually step in and investigate. If you were to hold the funds outside of Florida, the state's authority would be severely limited, which is totally unacceptable for public protection. Secondly, these funds can be placed into an interest-bearing account, but there's a major catch.
All parties must provide written authorization in advance, and they have to agree on exactly who will receive any interest earned. You can't just quietly pocket the interest. Finally, the broker must be a signer on the escrow account and on all checks drawn from it. This ensures proper oversight. For example, during a routine audit involving escrow file number 155784, regulators would verify that the broker maintained proper authority over the account and followed all required procedures.
Section 4. Monthly Reconciliation Requirements, your ongoing obligations. Setting up the account correctly is just day one. Maintaining it is an ongoing, monthly obligation that is a frequent stumbling block for brokers in the real world, and consequently, it's a highly tested exam topic. And this brilliantly illustrates exactly what is required every single month. Reconciliation is not just a quick glance at a bank statement. It's a formal, four-step verification process. Step 1. You pull your bank records. Step 2. You compare them against your internal escrow account records. Step 3. You cross-reference those with your transaction records. You're looking to ensure every single balance matches perfectly and that zero discrepancies exist. But doing the math isn't enough. Step 4 is absolutely critical. The broker must personally review and approve this reconciliation. To prove they've done so, the broker is required to sign and date every single page of the monthly reconciliation report. This documents true accountability.
Finally, Section 5. Mandatory record retention, preserving your evidence.
Okay, so you've kept the funds separate, you've stayed within the personal limits, you've used a Florida bank, and you've reconciled monthly. Great. Now you need to preserve the evidence of your good behavior. The Department of Business and Professional Regulation, the DBPR, has the authority to inspect these records at absolutely any time to ensure compliance with Florida law. You must maintain escrow-related records for a minimum of 5 years. This isn't a suggestion, it's a hard mandate. And what exactly constitutes these records? Basically everything. Bank statements, deposit slips, those monthly reconciliation reports you've been signing and dating, and any other escrow-related documentation. Maintaining this complete and accurate paper trail is an essential, non-negotiable part of your fiduciary and regulatory responsibilities. If the DBPR knocks on your door on a random Tuesday morning, you need to be able to hand over 5 years of pristine records.
To bring this all together, proper escrow management is arguably a broker's most heavily monitored duty, because at the end of the day, you're guarding the public's money. Commingling and conversion will cost you your career, which is exactly why Florida mandates separate accounts, strict personal fund limits, Florida-based banking, rigorous monthly reconciliations, and a 5-year paper trail. This compliance isn't just bureaucratic red tape. It's the armor that protects your license and the financial well-being of your clients. So, knowing how incredibly strict the DBPR is regarding these rules, I want to leave you with this to think about. As you step into your new role, how will you design your own daily operational fail-safes to ensure not a single penny of escrow money ever slips through the cracks?